Welcome to Stock Market Ideas. Thank you for joining me. Today I want to talk about Intel Corporation. I've actually spoken about this in the past. So I actually released a podcast 2 years ago, back in March of 2020, more than 2 years ago, on Intel. In fact, it was my very first podcast episode. And back then I believed it was undervalued for a variety of reasons. And actually, I'd like to reiterate just a couple of those points where I still believe this is a very high quality company and potentially a good investment for the long term, even though unfortunately we have seen a decline in the stock price over those past couple of years by about 32%. Just looking at some valuation factors, which we'll get into in a couple of minutes, I still think there is potential here that it is undervalued and potentially a good long-term investment. So this is what the main summary page looks like for Intel on the GuruFocus page. And if I haven't said it enough already in the past, GuruFocus is a tool that I absolutely love. I do a large amount of my research on GuruFocus. To me, very much worth it. Check it out if you haven't already. Now, there are some broader narratives that are probably the largest factors in bringing down Intel's stock price. First of all, there's no denying that there is a global semiconductor problem, to put it mildly. The global semiconductor market has been in disarray, to say the least, due to COVID-19 supply chain disruptions. To say that there have been challenges would be putting it mildly. Another factor is that there is no doubt that Intel has been under some very serious competitive pressure, most notably from AMD, and there is no shortage of commentary about the technological advancements of AMD and whether or not Intel is lagging in some of those areas. I don't want to get into a lot of those technical details, but it is very important in trying to look at where this business is headed for the long term. Now let's start with profitability. Intel has been a very profitable company for many years and continues to be very profitable. Simply looking at return on equity, for example, we can see that this has been a consistently positive number for many years. We can see today that it is about at a 27% point, if not around that range. And going back at least 10 years, it has hovered at least around 14 or 15 to about the mid to high 20s currently. Now, gross profit margins are also a very positive number with Intel. We can see that going back at least 10 years, gross profit margins have been in the 60 to 50% range, currently hovering around 54 to 55%. Ideally, a business that has over 40% gross profit margins has a durable competitive advantage of some kind because it has pricing power and its products are in demand and is able to charge a premium for its products. So this to me is a very healthy number, and I don't see it declining meaningfully, at least not anytime soon. Now, when you compare Intel to some other technology companies, you might not call this business much of a growth company, although there is a pretty healthy amount of growth, in my opinion, taking place. Going back 10 or even 20 years, we can actually see a very steady growth in revenue by around 5 or a little over 5% per year on revenue. So again, not a very large number, but it is very consistent, and that to me is a very healthy sign of consistent growth over many years. So at least when just looking at a couple of these factors showing that it's profitable, continues to be profitable, and has been profitable for many, many years, and is also somewhat growing. It hasn't been completely taken over by some other business or disrupted in any way by a competitor. Because let's keep in mind, Intel is innovating in a lot of the very important ways that we would expect the leader in semiconductors to be doing so. Again, it's not being disrupted where that technology is completely changing on a dime, where semiconductors are just going to change within all of the components and the technologies that we use or that we need them for. So there is innovation and growth there. The next big thing is valuation. So is this cheap enough where we can afford to be wrong about some of our calculations, or we don't need to be exact? The valuation here is going to be very important. And like I said a little bit earlier, I think that this stock price has declined further, and it's probably not as justified if we look at a couple of things. Now, first of all, you might notice that the price to earnings ratio for Intel kind of sticks out like a sore thumb. It's just above 6 for PE, especially in a technology company. This is pretty unusual. But if you look back at Intel's history of its price to earnings ratio, it actually has been fairly low compared to other technology companies for quite some time. It just hasn't been this low. So if we look at the historical chart of Intel's PE ratio going back at least 10 to 15 years here, you can see that it has hovered between the 6.2 level, which is the lowest that it's been, at least on this chart, to all the way up to 25 or 26 here in 2018. Now, please do keep in mind that earnings is a huge part of this ratio, and some people would say that with earnings declines possibly on the horizon, earnings forecasts to be reduced, those kinds of things can really play into this number and change what it really is in its present state. Now that's where a number like forward PE ratio could be interesting. But again, if management changes its earnings guidance, that could also change these ratios very quickly. Now, GuruFocus has this really interesting way of displaying different possible valuations that you might assign to a business. And here we can see that based on a number of different calculations, Intel could be said to be undervalued. Notably, you'll see the DCF earnings-based calculation here shows that the intrinsic value of this business based on that calculation should be a little over $107 per share. But again, there are a few variables that go into this calculation, especially earnings, that could certainly affect what the real intrinsic value of this business might be, or what you would assign to it. So here you can actually see a couple of the assumptions that have gone into the DCF earnings-based calculation. Automatically, GuruFocus assigns a 10% discount rate, which is like comparing it to what the long-term stock market returns are. Some people might argue that it's not going to be 10% for the next little while, so you may want to reduce that number. You can see here that the calculator also hasn't added the tangible book value, which in many cases I would prefer to add to this calculation to be a little bit more accurate. Now, estimating growth can play a huge factor here, and of course we have no idea what's going to happen in the future. And as I said earlier, Intel is not necessarily the fastest growing business, although there has been a lot of consistency over the years in its growth. Here the calculator has picked up the 10-year growth rate on earnings per share without non-recurring items, so that's a little bit different than the revenue that I looked at a minute ago. So just to be a little bit more conservative, let's reduce the growth rate and see how the calculation looks. Now, even if Intel grows at just 5% per year for the next 10 years, you can still see that a margin of safety of almost 60% is still assigned to this business with a fair value of over $92 per share. Now take that down even more with almost no growth whatsoever, and still, according to this calculation, we're showing Intel to be relatively undervalued based on these numbers. Now, I don't pay a ton of attention to dividends that a business might be paying, or at least I don't put a lot of weight into the dividends that I'll collect on my decision to buy or not buy an investment in my portfolio. Certainly it's important to know, and especially to note whether or not paying a dividend is healthy for this business. So we can see that Intel actually has a long history of paying dividends consistently, and recently, especially again due to the decline in the stock price, the dividend yield has increased. So some people like to compare this to bond yields or to other investments that might pay them cash. It also does appear to be a pretty healthy dividend payout ratio. That means that consistently paying this dividend is not going to be something that's hurtful to the financial position of this company. So it's not going to have a problem to cut the dividend, for example, in the future, which is a concern for some other companies that can't afford to pay the dividend consistently. So yeah, this is a pretty healthy dividend. And if you're interested in collecting dividends, this might be something that you're interested in. Now, the GuruFocus value, or the GF value feature, is something that's relatively recent here that GuruFocus added. I think it's very interesting, and there's some interesting calculations that have gone into providing this value for businesses. Now, I know this might sound cliche, and it's something that will probably never not be said, but it does seem to be a market that is going through some pretty significant turmoil with interest rates rising and inflation taking over. We really can't expect to have more of the same when it comes to the valuations, especially in technology businesses. So I'm not too sure how consistent these charts or calculations are going to be able to hold up over the years. But we do know historically that if we look at businesses that have healthy positions within their marketplace, good strong earnings, and a consistent multi-year show of earnings, ideally at least 10 years, while there will always be market turmoil and good businesses like these can be dragged down with everybody else. To me, it looks like there's a good possibility that Intel is a high quality business that could be discounted at today's valuations. I hope you found this helpful. Thank you so much. Take care and have a wonderful day.